Yesterday on this show, Christina Hooper from the Man Group was talking about how valuations have gotten sky high, and she doesn't think they can stay that way, and the market is due to tank. Today, check out this.
Valuation becomes less important when you have high conviction in sustained growth of earnings, economic growth, and high return on equity. Now, down the road, if this cycle slows down, we do need to pay more heed to valuation. But at this moment, we think the E in the PE ratio is far more important to be aligned with. And so while we'll concede that the U.S. market is stretched on valuation, and we're at target and neutral in the U.S., and we're overweight other areas that are a little bit more attractive, but overall, we would not let valuation be the reason that investors sit this out.
That's Jeff Blazek, Co-Chief Investment Officer from Multi-Asset Strategies at Neuberger Berman. And they think you shouldn't be so worried about valuations because the market has room to run.
Say no more. You're confusing me.
Oh, but we're going to say a lot more because we start today's show with David Bush, Co-Chief Investment Officer at Trajan Wealth. And later, the market call features Ivana Delevska, founder of Spear Invest, manager of the Spear Alpha ETF. Let's go. Welcome to Money Life for October the 1st. We got a very busy show planned for you, and all that's without me talking to you about the federal shutdown, the government shutdown, which I am about to do right now. But yes, a great lineup for you. And I don't want you to be confused, but this is the different take on valuations. What do we say? Disagreement makes a market. And Christina Hooper did not disagree with the idea that you make hay while the sun is shining. In fact, she talked about it. She just used a thing about, continuing to dance while the music plays instead of making hay. Any way you cut it, she was talking about sticking with it, but she was forecasting something worse. I could have picked a different quote from Jeff Blazek, one, in fact, that we will use in our promos today. And if you don't see our promos, they're on YouTube. They're on our Facebook page, at Money Life Show. You can find them. Follow me on LinkedIn. You'll find them there. We put them on Instagram. We put them on X. Put them on Blue Sky. So you can find them in all those places. It's Instagram as well. Follow us wherever you can, and you'll get our promos. But there's a promo quote where basically Jeff Blazek is saying, we expect the market to do big things as we push forward. So very different from what you got from Christina yesterday in terms of what happens next based on valuations, right? One is saying we're going to succumb to the high valuations. The other is saying we're going to overcome the high valuations. Disagreement makes a market. Disagreement is not making anything better in Washington, where the federal government just shut down. I'm going to try to run through what all this means. I've made a list. This could be over fairly quickly, or maybe it lingers because, the last time we did one of these, 2018 into 2019, it was almost a month. Let's start with the market, as we discussed with Dominic Papalardo from Morningstar on Monday's show. It doesn't really have much impact on the stock market. In fact, that shutdown that we had back in 2018, 2019, the S&P 500 gained during that period. That's going to happen. The two things are not correlated. Bigger things, the market might respond to the fact that there's no jobs report coming on Friday if this stays where we're at. The report on non-farm payrolls is an important one for investors and for the Fed, right? The Fed has to decide whether it's going to cut interest rates again. They've said they're data dependent. I think the way the data was flowing, if they don't get anything, they don't do anything. Now, Social Security checks ended yesterday, but that has nothing to do with the shutdown. That has to do with the fact that, as I also mentioned on Monday's show, there's rules that were put in place that basically there will be no more Social Security checks or IRS checks. They will be doing it all electronically with the exception of a few places where they can't. But Social Security payments, your benefits, those will keep coming for Social Security, for Medicaid, Medicare, that stuff will keep coming. Card issuance, so for example, we're waiting for Declan to get his Social Security number and a Social Security card. That may not happen. The Postal Service, day-to-day operations are not funded by tax dollars, so the U.S. mail will continue to be delivered. Amtrak, while Amtrak is going to continue running, or that's the expectation, there may be some delays, some things along those lines. Then you get to things like, okay, what's going to happen with IPOs? IPOs shouldn't be an issue, or you think they wouldn't be an issue, but they do need the SEC, the Securities and Exchange Commission, to act on registration statements or to answer questions that need interpretation if there's some sort of logistical thing while the staff is furloughed, but also afterwards, because they come back and there's a backlog of business, you could see the IPO process get a little sticky. It happened back in 2019. There was some delays in IPOs that were anticipated and they didn't happen on time or what have you. So we could see that it would take a little while for that, I think, to occur. Federal workers who are deemed essential, that means border security agents, prison guards, military personnel, they're staying on the job, but 750 to 850,000 others are going to be furloughed. When the government reopens, those who were furloughed or required to work during the shutdown are guaranteed to get paid. But there have been some federal contractors, people who are not actually government employees, but who were under contract, who have not received back pay in the past. And then there's just that question of whether this shutdown will be different, in that the White House Office of Management and Budget has indicated that agencies might use this and pursue layoffs. If you've got a program that lacks funding, rather than furloughing people, they may just say, hey, we don't have the funding, so we're just going to cut your job, period. We could see some of that too. So it might be a little bit different for some employees. And for those employees, it's not a little bit different. It's a lot different, because that's losing your job as opposed to getting paid for it eventually. As for the impact on the economy, that simply depends on the shutdown's length. You know, that shutdown 2018, 2019 lasted over a month, and it did reduce spending a little bit. It did have an impact, but it took most of that time to get there, so wouldn't expect it. If you're going to airports, well, TSA agents are considered essential, and so are air traffic controllers, but that doesn't mean you won't have longer waits, which did happen in 2019 as well. You'd like to think that it won't result in less safety, but it certainly should result, if you are traveling, in adding a little bit of time to make sure you're going to make it through the airport screening process. And then national parks, majority of them are closed, but they can't all be closed, because if they got roads and things, it's sometimes impossible to restrict public access. One fallout that I remember from 2018, 2019 is that there were Park Service sites that were kept open, but they didn't have the services of the workers. So you wound up with big piles of trash and people saying how terrible that was for what it was doing. So if you are going to a national park, understand that there may not be help for your trash. So take out what you bring in and try to make this better for everybody as we get through this whole thing. If you can think of anything else that I've forgotten, let me know. But there's your quick and dirty take from me on what that does. And speaking of quick and dirty, we got that coming at the end of the show. But right now, let's get to the talk. Again, David Bush from Trajan Wealth, Jeff Blazek from Neuberger Berman, Ivana Delevska from Spear Invest. It's a great day to live the money life, even if it's not a great day to be a federal employee or what have you. And we'll prove that the money life is worth living right after this message.
Exchange is more than a finance conference. It's a community. Join us to gain insights and connections that last. Visit exchangeetf.com.
We start today's talk with the other interview on this show. Joining me now, David Bush. He's Co-Chief Investment Officer at Trajan Wealth. TrajanWealth.com, Trajan, TrajanWealth.com, where they have over $2 billion in assets under management, and he takes a look at their multi-asset strategies. You're going to hear a lot about that on today's show, and also does a lot of their global markets research and more. Again, TrajanWealth.com for more information. David Bush, welcome to Money Life.
Well, thank you. It's a pleasure to be with you today.
We are entering October, and for all the seasonal impacts that people were worried about as we got into August and September, the fact is October is the month that scares people, and that's not about Halloween. That's about when we've had past market crashes and the rest. So is there anything with a market at record highs right now that scares you, that is genuinely, more than just climbing the wall of worry kind of scared?
There are a few things that I'm monitoring closely. One is what the Federal Reserve's next steps are going to be. Two is the potential government shutdown. And then three is stress on the consumer.
And in terms of the outcomes you expect, the shutdown, we should let everybody know as we're recording this, we're still waiting for news on how the shutdown will play out. But the shutdown itself is fairly short term. The other things are not.
That's right. That's right. And one of the big issues with the government shutdown will potentially be we may not get some of the economic data that is scheduled to come out in October. So that's really, the one area where I'm focused on in terms of the shutdown. With the Federal Reserve, we have a slate of speakers this week. So we're going to be looking for any indications in terms of the next steps for the Federal Reserve. Interestingly enough, we have cooling inflation and labor markets are somewhat strong, but we're starting to see some cracks there. So the Fed has a moment of decision to make to continue to ease. The market is priced in, two more cuts for the remainder of this year, one in October and one in December, or do they pause if we see a strengthening of the labor markets? So that's one area that I'm really focused on because that can have real world impacts in terms of not just investment yields, but also borrowing rates.
When you consider where this market has come, it's ahead of most expectations. When we were looking back 9 months ago, the forecasts were not bad. I mean, there was some talk of whether we'd have a landing and what kind of landing it would be, but there wasn't, oh, things are going to be terrible. They just weren't necessarily expected to be this good. Then we got into April, we had the tariff news, and everybody was now saying, okay, here comes the recession and all these other sorts of things. As you look out now, how long does this go on? Because consumers believe there's got to be an end, that, what goes up must come down to some extent. So how long do we continue without a landing or some other problem?
Well, in terms of economic landing, I think the Federal Reserve, like I said, has been in sort of a conundrum because cooling inflation, but also strengthening, or I should say, softening labor market. In addition, S&P valuations are at all-time highs. So historically, one of two things has to happen: either prices fall, or earnings growth will continue and will meet that demand. And so that's really what the market is focused on, is that earnings growth component, specifically with big tech and AI and large cap growth in general. It remains to be seen. And so what we'll be following closely is earnings announcements and earnings guidance.
Earnings have driven the market this year. When you say you're going to follow earnings announcement closely, how do you judge broadly? Because in this environment, it has been tremendous earnings. That's, of course, been a great thing. But there are those examples, maybe because they're fewer and further between. They're the ones that are getting the headlines of companies that have had a miss here or there, et cetera. So what will be the trend? Are you going to be looking to see if it's the biggest names, the Mag 7 and those keeping up their earnings, or is it a broad thing? How will you judge that this earnings push and power can continue?
Well, with the S&P 500, because it's a market cap weighted index, the top 10 companies represent a significant portion of the index. I mean, it's like roughly 35% of the index. So those top names are going to drive index returns. In addition, I'm also monitoring the broadening of the market. So with lower yields, that should benefit financials, consumer discretionary, and so on. But it could also hurt sectors, defensive sectors like materials and so really what we're looking for is we've got to keep an eye on those big tech names and their earnings announcements, because that's going to drive index returns, but also looking at that broadening of the market.
Where are you on domestic versus international? International has had a gangbusters year, but there are some folks who say that's mostly because of currency impacts, and there are others who are saying now the valuations are so compelling that you got to stick with it. Where are you on that take?
Primarily, we're domestic. However, we do have an allocation towards international stocks. A couple of areas that we're focused on. One is India, mainly because of the population growth. It's got all the right fundamentals. In theory, that's where a lot of the production will be moved, from China into India. So they've got the demographics, they've got everything going for them. So that's more of the growth play. And if you couple that with something like a Switzerland, is kind of seen as that, steady, value-oriented type investment as well. So yes, we're broad international, but focused on India and diversifying that risk with an allocation to Switzerland.
You know, you can never judge from just one or two things. However, a couple of mentions for Switzerland on the show in like the last week and a half, 2 weeks, and you probably could have gone back 5 years before that and maybe found one time, like in all that time. So that to me is interesting as we're seeing that kind of play. A play that has been interesting to the public has been alternatives. Where are you right now with alternatives? Because to some extent, they have been what people were turning to get alternatives to the market, et cetera. But now there are some who worry that that's where the problems are going to surface.
Yeah, for alternatives, we take a different approach. I know a lot of advisory firms will, use like a fund of funds type strategy. And what we have done is we've curated specific opportunities for our accredited and qualified investors to come in as limited partners to a specific private equity fund that has a specific project or investment opportunity. And the reason we're doing that is because, with fund to fund strategies, typically they'll be layered with fees because you have the private equity fund fees and then you have the 40 Act fund fees on top of it. And so we're trying to cut out a lot of that, the fees that are charged with those fund to fund strategies and just lean into direct investment opportunities. And where we see the most value is in that upper middle markets and middle market space. And the reason is because, all the big players out there, if you think of the Blackstones and the BlackRocks of the world, they're focused on the biggest deals. And so that's going to could potentially water down the returns. Where for us, we're leaning into that middle markets and upper middle markets space.
Taking it from equity markets to fixed income, I read a commentary of yours over a month ago. At the time, you were looking at more effectively trying to use TIPS, Treasury Inflation Protected Securities. We have found inflation to be sticky, but TIPS have not been a big part of the conversation, at least out in the mainstream. Given where inflation is, how are you using TIPS now, and how do you think investors should be keeping that portion of their portfolio? Is it worth it to get the inflation protection at this point?
Yeah, so what we're doing is, we're focused really on the short and intermediate part of the curve. So call it 3 to 5 years. You can even go 3 to 6 years. And the reason is because as the Fed starts to lower rates, that part of the curve should benefit. Now, we're leaning into quality, so it's treasuries, IG corporates, for those who need the tax-exempt income, high-quality munis. High yield, we're a little, I don't want to say cautious, but we're, with high yield specifically, the companies, that we invest in on a high-yield basis need to be completely, underwritten, all of our due diligence done, and that we're confident with those companies. On the TIPS side, the allocation towards TIPS is really just a hedge against what I'll call inflation volatility, meaning the volatility that the market experiences from changing inflation expectations. And so if, inflation remains persistently high, or if we see a resurgence of inflation, we've got a small allocation towards TIPS to help manage some of that volatility. So I think on average, it's roughly 5%. So it's not a huge allocation. It's just a small allocation to help manage some of that volatility.
David, really interesting stuff. I appreciate you taking the time out to join me on the show. Hopefully we'll get a chance to do this again sometime.
Yes, thank you so much. And I appreciate this opportunity.
That's David Bush. He's the co-chief investment officer at Trajan Wealth. Trajan, Trajan, TrajanWealth.com if you are looking for more information on David and the firm. And if you're looking for more information on the markets, well, buckle up, because up next, it's the big interview. Jeff Blazek, co-chief investment officer at Neuberger Berman, will be here when Money Life comes back in a moment. It's time for the big interview on today's edition of Money Life. Joining me now, Jeff Blazek. He is co-chief investment officer for multi-asset strategies at Neuberger Berman. If you are not familiar with the firm, well, I'm not going to have to spell Neuberger for you because nb.com is their website, but it's a firm that is an old line money management firm that has somewhere around $550 billion in assets under management last time I checked. I've always said I really like the folks that I've ever always talked to from Neuberger Berman, but I don't talk to them often enough. So I'm really glad that for the first time in a while, I have somebody from the firm on the show. Jeff Blazek, it's great to have you here with me on Money Life.
Thanks so much, Chuck. It's great to be here, and I'm glad I'm helping break the seal on the Neuberger, the vacuum we had for a while.
Yeah, I think it may have more to do with like who's overseeing PR at various times for the firm. I'm not sure. Or maybe it's me. It could be that Neuberger is a firm with a great reputation that's not necessarily always front of mind. And maybe that's what we need to do. But let's go to front of mind with what we're seeing right now with the market and the economy and just get the base case for how you expect this year to finish, because there's plenty of headline risk, but there's a market at record highs. And there doesn't seem to be any sign of, some sort of an economic landing or recession unless we get surprising news. So where are you on how solid or benign or whatever adjective you want to use is on this market?
Yeah, well, Chuck, the headline is we're quite constructive. We're bullish. And really, when we go back to April, Liberation Day, we had made a decision on our asset allocation committee to upgrade global equities at that time. We actually technically did it in March. And then April 2nd happened. You can imagine we had a little bit of a deer in headlights look like, wow, this is pretty severe. But we did a gut check and said, well, we knew there was going to be a storm before the calm. We knew that tariffs were going to be the initial noise, but once that dust settled, we came in with strong economic trends, strong consumer spending, the opportunity for M&A. And so we felt, well, valuations are even more attractive now. Let's lean in. And now here we sit in September, and we see the fundamentals are quite strong. We're leaning into risk assets. We're overweight global equities. We remain that way, and we have a very strong outlook for 2026 and beyond.
But that's interesting because in that explanation, you talked about valuations and where valuations were as we were coming through Liberation Day. That is not where valuations are now. So how do you make the case that we're not too stretched right now?
It really is a key topic, and we've internally been discussing about the importance of valuations as a tool. And I think when you're in a moment of uncertainty, like we were in April, let's not sugarcoat it. It was a fairly bleak environment where even the integrity of the treasury market was under scrutiny. Volatility was exploding. There was just a lot of fears out there. And at moments like that, where you have a gut check, where you are going to be buying assets, valuation is a critical tool to make sure that you're comfortable, because when there's uncertainties, you want to have a sense of the downside. Now, it's hard to believe it's only 5 or 6 short months later, but valuation becomes less important when you have high conviction in sustained growth of earnings, economic growth, and high return on equity. Now, down the road, if this cycle slows down, we do need to pay more heed to valuation. But at this moment, we think the E in the PE ratio is far more important to be aligned with. And so while we'll concede that the US market is stretched on valuation, and we're at target and neutral in the US, and we're overweight other areas that are a little bit more attractive, but overall, we would not let valuation be the reason that investors sit this out, because they could be missing a lot of future gains.
Let's go back to that comment in there about you're neutral on US and you are positive elsewhere, because implicit in that is the way you're going to answer a question that I was planning to ask, which is we've seen great things internationally. There are two schools of thought. There is the school of thought that says, there's your rally, it's now played out. And there's the other school that says, no, that's the rally we've been expecting and it's just getting started. If you're not in love with the valuations here to be any better than neutral, and there are other parts of the world that you've hinted at, where in the world are you investing and how good can that picture be?
Yeah. First of all, when we're neutral in the US, that means you're still probably putting the majority of your portfolio to work in a structural sense. So, we are enthusiastic on it. We just don't think a tactical overweight makes sense at this point. However, the tactical overweights we do like are a couple. First of all, Japan. So Japan has really had a renaissance, in our view, around governance and the ability to generate higher returns on equity for their shareholders. So this has been in motion for a few years and it's been validated. And we're now seeing the ability for the Japan indices to be cyclically tied to the recovery and global growth after the choppiness we went through in April. The other area we upgraded recently was China. So this was a situation where the bar was quite low because you had stocks that were trading at 9 times or 10 times earnings. I'm not talking about EBITDA multiples. These were price earnings ratios. And when you look under the hood at China and the way it is positioned around technology, a lot of cutting edge innovations, and to be paying that deep of a discount on the equities, to us, that felt like a really good opportunity, assuming that the Chinese government will do what is necessary to stimulate the economy and keep it at a decent 4% type GDP growth. But those are really the biggest overweights. One area that you may have noted I've not called out was Europe, which we did upgrade and has worked really well for us this year. Europe has been one of the best performing geographies, both in local terms, but especially when you factor in the weak dollar. We see some of the European markets that are up 25% this year. But as we're kicking the tires on that thesis, we're getting more cautious because we got bailed out a little more by currency and by PE expansion. And we're seeing a lot of disappointment in the near term earnings. So right now, the second quarter earnings growth for Europe was only 0% or maybe 1% up. And so we want to reassess and see how that goes. We think there's still some positive structural catalysts, but we've gotten a bit more cautious on Europe because of the growth outlook.
Which means I think you just answered that question of which camp are you in with kind of both.
That's right.
You're looking at both sides, and it's the Europe side that you're not sour on, but not as excited about, et cetera.
We're fading.
China's not the place that I hear about from everybody, in part because there are a few headline risks that go along with China right now. Given where we are, where I think most people believe they haven't seen much of the tariff impact yet. Is that coming? Is there a problem? Or if we haven't seen it yet, you're not going to worry about it till it shows up, if it shows up?
First of all, I think China navigated the tariff disputes fairly well. They held their ground in April, May, and June and ended up getting exemptions on key sectors of areas of exposure to the US where they were able to mitigate a lot of the near-term pain. Another thing I would point out is compared to Trump 1.0, China's share of its exports tied to the US was much higher. So they've been managing that, diversifying it away globally. When we look at the data, I mean, we're still seeing growth in exports in China. So despite all of the tariff disruptions, the fundamental growth in their exports has been healthy. The risks I would point out, though, on China is not only the demographics, the property bubble overhang, but also their ability to transition from an investment led economy to a consumer driven economy. We think they need to be making more progress on that. And there is a risk of this deflationary pressure that they put on the rest of the world by flooding the world with goods, goods that Europe wishes they had higher market share. So, I think that's going to be a continued ongoing challenge. I'll again say, though, that when we look at the tech sector exposures, as well as the fact that the bar was so low with those dirt cheap valuations, we felt it was the right time to get long on China.
Given what you were talking about with the earnings picture in Europe and the idea that some of the gains there were currency gains, when you were talking about the domestic markets, you were talking about how the E and PE is where you're finding things right now. And it's not a big surprise. But a year and a half ago, when we were having the last round of rate cuts, it was rate cuts that drove the market. It was obvious entering this year that it was all going to rise and fall on earnings. But now we have another series of rate cuts. We've seen rate cuts internationally. They were ahead of the Fed, and it didn't have any impact or change the fact that that earnings quotient was so important. So now that we've got rate cuts here, will we get the impact that we traditionally expect rate cuts to have? And will they be a boost if earnings start to flag? Or nope, this is still all going to be about earnings and rate cuts, not so important.
Yeah, the Fed watching aspect, the cuts and the impact it has on risk assets is more complicated. And there's a few reasons why. First of all, we were not of the view that a terminal rate below 3% is likely. So we have been at a terminal rate, so the neutral rate where we think the Fed will eventually get to bring balance to the economy, is probably 3.5%. over the last 18 months, you were mentioning, we've been having a lot of Fed watching off and on over the last 18 months. But we've seen the market pricing as high as 4%, all the way down to almost 2.5%. It's been flagellating all over the place, responding with a very high sensitivity to economic data points. And that's logical. I mean, that's what market participants do. But that has driven a lot of opportunities to be a relative value investor in fixed income. And we've been dynamically managing our duration exposure when we think the market's gotten too hawkish or dovish. So 2 weeks ago, the market was too dovish, and they've unwound that. So we've actually seen a Fed cut taken off the table in the last 2 weeks. And so I wrote a couple of weeks ago on our website, nb.com, which you were kind enough to mention before, but I called it the search for Goldilocks. Really, what is going to inform the way in which the Fed will cut rates and the level at which it will stop is going to be the balance between employment and inflation. And what I would say is the employment side has gotten so neutral. It's come down very quickly in the last 2 or 3 months. It's given air cover to the Fed to kind of look away from the inflation side, which is still too hot. It's at, core PCE came out on Friday. It was at 2.9%. That is not a very dovish signal. But because of the warning signs on the employment side, the Fed has enough of a Goldilocks blend of its porridge to taste and say, yeah, we can go ahead and do a 25 basis point cut and kind of guide the market to continue that until we see this balance upset in one direction or the other. So, because it's a data-driven, data-dependent Fed, that's why you're seeing a more cautious response from risk assets on how they'll think about Fed cuts. Whereas last year it was off to the races, small caps rallied, a lot of things worked because it was just this party of like, yay, we're finally getting started on Fed cuts. It's a lot more complicated right now.
Given that, you talked about moving around on duration and what you're doing there, but given that, what is the sweet spot in fixed income as we see the Fed enter a rate cutting cycle that is likely to be more muted than people were thinking it would be just a couple days ago?
Absolutely. So we are neutral duration. So all of the investors that listen to this show, first of all, you should define, what do you need from fixed income? What role does it serve in your portfolio? If you're a pension manager, you need long duration because you have a liability that has a long life and a lot of interest rate sensitivity. And if you're a retail investor, you might be in munis, but you may not want that high volatility in something like bonds. So set your target. Your target duration might be intermediate, it might be long, it might be short. And once you've set that target, then you can express a relative value of saying, I'm going to be a little bit more interest rate sensitive because yields are high and they're attractive, or I'm going to be a lot more cautious and kind of pull in the reins and get shorter, or maybe even put some money in cash. Right now, we're neutral. And there have been times this year that the 10-year treasury got as high as almost 5%. We were leaning in, we were buying rates. We liked rates exposure. And then on this pullback down, we're now at 4.15%. So it's been a decent range to play. But we would define it about 4% to 5%. And that's been working. We breached it briefly below 4% in the spring when there was a lot of fear around Liberation Day. But by and large, I would say fair value is probably about 4.4 to 4.5. And so right now, be neutral, maybe even be taking some duration off the table because there's still uncertainty.
You talked previously, before that last question, before we moved to fixed income, about how we were set up for a bit of a small cap rally. We have seen a small cap rally, but just as we saw the rally in international and we've gotten to an inflection point, well, now with the small cap rally, we're asking the question, is it real or is this just another head fake in the small cap space? So is this real?
I don't know the age or demographic of this podcast, but I'm going to cite Peanuts and Charlie Brown. The metaphor I always like to use is when Lucy would hold the football and Charlie Brown would talk himself up as he kind of walked to get the running distance ready. And he'd be like, this time it's really happening. I feel it. I can kick that football. And he would run. And then, of course, she would pull it back. And small cap to me has been defined by that Lucy pulling the football for so often over the last 5 or 10 years. And so small caps have been cheap for a while. If you look at long-term historical valuations, do a scatter plot. It would tell you, you buy small cap, put it away for 10 years, don't even look at it, and then see how it played out. You should be earning 8% more per year just by holding small caps. That's what the data would say, but we know it's been wrong. And we have been too early on small caps too. We went overweight in mid to late 2024. And the simple reasons why it has not worked so far is because interest rates stayed higher for longer, and small cap companies have a lot more debt, and it tends to be floating rate debt. So that hurt them. But secondly, even though they tend to be more domestic in the way that they have their sales and their businesses, they are quite sensitive to tariffs, as it turned out. It's pressured their margins, and they have narrow margins to start with. They don't generate as high of a margin as a large or mega cap company. And so a lot of that uncertainty was paralyzing to small caps. We saw small business sentiment was negative. The good news is we did stick with the small cap underweight, another area we've discussed a lot in our asset allocation committee. And now that we have seen the Fed hit the play button on the recorder, getting ready to start to cut rates again, and more importantly, tariff uncertainty is mitigating and the cyclical recovery is starting. We're seeing a broadening out of economic momentum and earnings. And that's why the Russell 2 ripped in August. It was up about 7 or 8%. By the way, the Russell 2000 is probably a lower quality expression of what we would prefer because there's a lot of unprofitable companies there. We would recommend investors be active in small cap or invest in something that's higher quality like the S&P 600. So kind of a blend of a SMID, small cap to mid cap. But yeah, we do think it's going to work. We think it's going to finally pay off. And that valuation differential will really manifest well if we can sustain some solid economic and earnings growth.
You mentioned some of your commentaries, like the search for Goldilocks. And I'll tell you what, since we've mentioned it, we'll put a link on our guest page. If folks want to find that, they'll get a link directly to where it is on nb.com. But I know that you've got to be starting right now to put together your outlook for next year. So give us the earliest preview without giving away much. But when you talk about 2026, are you going to use words like landing or recession or something? Is your early forecast that stuff that we've been expecting that hasn't shown up is going to show up?
Very astute for you to point this out. We're getting to that time of year where the outlook discussion starts, and we are going to be convening internally. By the way, the Neuberger variant of this, we call it Solving for 2026. That's the way we brand it, and we certainly would welcome your listeners to read our blog when it's published. It'll probably be a month or two before we do so. And so while I can't give secrets in terms of what has been put on paper, but some of the things we're discussing internally, the productivity enhancements of AI, will this be a catalyst to get U.S. productivity above 3% or greater per year to help juice GDP? But what does that mean for the balance of employment and economic growth? Could we see a strong economy, even if we see a tepid, if not mildly contracting labor economy? And what does that mean for the haves and the have-nots? That's one thing that's going to be top of mind. Fiscal always has to be on our minds. So not just in the United States, but in France, Japan, the UK, the fiscal burdens and deficit spending has been at an unsustainable level. And this will rear its head as a lot of bond issuance is coming. So, we had a very strong call this year for steepening yield curves, adding risk premium to the longer end of bond market curves. And we have been tapping the brake on those trades just to reassess, but that's going to be a critical question for 2026. And then the final thing I'll call it is stimulus. So between the OBBBA, there's going to be a ton of stimulus in the U.S. economy that comes from that, particularly after we begin to normalize the tariff effect. And even if the Fed does another 1 percentage point of cuts, that alone has a stimulative effect of about 1% of GDP. So there's a lot of tailwinds that can really work their way through to set the stage for a rock solid 2026, at least in the first half of next year. So I think you can hear we're still pretty bullish going into next year. And the types of things that we're looking at in terms of risks are more manageable. And they're kind of like known unknowns rather than the unknown unknowns like we saw with Liberation Day, which was a wild card.
Hey, if you can navigate the future with a little bit more comfort and certainty, it's a good thing. Jeff, we'll be watching for that solution for next year as you guys put that out. Meanwhile, thanks so much for taking the time with me today.
Really was a pleasure to be here, Chuck. Look forward to the next conversation.
That's Jeff Blazek. He is Co-Chief Investment Officer for Multi-Asset Strategies at Neuberger Berman. Yeah, they made it easy. Their website, nb.com. Don't be shy about checking it out. And speaking about checking out, well, we're only checking out of this show for just a minute. We'll be back with more talk in just a second, right after this message. This is Money Life.
Everything an advisor needs in one newsletter. Go to advisorperspectives.com and see why 100,000 advisors are subscribed to our newsletter.
Ivana Delevska, founder of Spear Invest, where they run the Spear Alpha ETF, is here. We're talking industrials and industrial technology. It's market call time. Welcome to the Money Life Market Call, where we talk with experienced money managers about how they do their job, what they look for that determines their buys and sells, what they see happening broadly on the market, and how they put it all together. Returning to the market call today, Ivana Delevska. She is the founder at Spear Invest, which, just like it sounds, and if you want to learn more about it, spear-invest.com is the website. They run SPRX. That is the Spear Alpha ETF, which is an actively managed fund that brings together its research, is focused on industrials and industrial technology companies that are B2B companies. In other words, it's not really the consumer companies and the things that face you as the consumer, but it's what's happening that's there and improving the industrial supply chain and things along those lines. Again, if you want to learn more about SPRX or Spear Invest, spear-invest.com. Ivana Delevska, great to chat with you again.
Thanks for having me on, Chuck.
We always start with methodology, so let's start with yours. Obviously, it is proprietary. You can't give us all of the secret sauce, but what is it that you are specifically looking for that's going to make an industrial or industrial tech company stand out to you?
Well, Chuck, we have a very differentiated method of picking our investments. And what we do different than most is that we cover the entire value chain. So we cover about 120 stocks, and at any given time, we narrow down to 5 or 6 focus areas that we believe will deliver outsized return potential. And then really where our differentiation comes is going one layer deeper and finding the 1 to 3 winners in each area that are positioned to deliver outsized returns. So really the core of our strategy comes from the fundamental focus, understanding these companies better than anybody else. And that's really what we do.
It puts you in an interesting spot in the business cycle. And I'm wondering, have you seen some of your companies, particularly maybe some of the international companies or what have you, more impacted by tariffs than others? Because if you are doing B2B, I mean, I told the story the other day of how my side gig where I run a lacrosse league, we were going to buy some equipment and then it was the tariff thing and we put off the purchase. So the commerce wasn't done. Are you finding that in some of these cases, the tariffs are having more of an impact than they are in what's been making the headlines on tariff impact?
Well, Chuck, interestingly, I think when the tariffs were originally announced, people expected the impact to be much bigger than we're actually seeing it be. We're seeing some impact on our industrial companies that source components from abroad, but even the guidances that they provided initially have been much more muted than what the impact ultimately came out to be. So I think for B2B specifically, a lot of the companies that we invest in have tremendous pricing power. So they're able to pass through higher costs onto the supply chain. So we haven't seen nearly as much or as big impact that we anticipated going since the tariff announcement.
The flip side of that question would be the government tackled tariffs first, and it's moving towards deregulation and some of those things, which are expected to help certain businesses. If that helps with capital expenditures and the rest, is that going to put your companies in the sweet spot?
That's right, Chuck. So that's really where we're seeing a lot of positive impact coming from. Basically, a regulation has two main impacts on our portfolio. On one hand, the energy companies and the power generation companies, they're supposed to be bringing capacity online in the form of nuclear and gas generation. And as you know, this industry is very highly regulated. So any help on the regulatory front in bringing this capacity online faster than expected would be very significant for our company. So companies like Constellation Energy is one that operates the largest nuclear fleet in the United States. They are going to be bringing back some of their idled capacity and adding new capacity. So the regulatory environment is really important for them. Then on the flip side, I would also say that more broadly, AI regulation, less regulation is better for our companies, and more kind of clear and broad regulation is also going to be helpful. So the AI space, especially as products start moving from just being AI agents and search to being more physical, like robots and autonomous vehicles, regulation is going to play a key role here. So a looser regulatory environment could really boost growth for these companies.
And you cited Constellation Energy earlier. Is there a company or two in the AI or AI adjacent spaces that you're particularly thinking of when you make that comment?
Yeah, so in the AI adjacent space, the few areas that we've narrowed our focus to is on the infrastructure build out side. So this would be companies that provide the networking and the chips. On the chip side, our top pick is still NVIDIA. On the networking side, we like some smaller companies. One of them would be Arista Networks, Astera Labs, Credo Technologies. These companies really play at the core of where we're going to see the performance improvement coming from on the chip side. So that makes them very interesting investments. Then an adjacent area is cybersecurity that we're really focused on. Cybersecurity is going to benefit in two ways. One is with AI products gaining broad adoption, you're really going to need to make sure that you're using them in a very secure way, especially these AI agents, right? You can't really have them have access to your company data without proper security. And then another area where we see AI having a big impact in the cybersecurity space is the cybersecurity companies themselves are using AI to launch cybersecurity chatbots and agents. So those are some of the more interesting areas within the broad space that we've really narrowed down to. And for your audience that is not as familiar with our products, really where we add value is that we end up with a very concentrated portfolio. So that's how our returns really differentiate from a passive index.
Well, and in talking about that activity, you can see cases like you were talking about AI and regulation and what it's going to do to service centers, et cetera. And I've heard both sides of that story. I have heard people say, well, look, it's really going to help because you're going to have more agentive AI that can take care of people. And then you've got the flip side of that, which is you've got less need for the people that are currently providing the call centers and the rest. And so some of those companies will suffer. So, what makes you sell? Because you are clearly looking for stories that are backed up by numbers. But once you've found it, what makes you back away from something?
So we have a very fundamental process in terms of how we model the upside in our companies. And upside usually comes in two ways. One will be on the company surprising or on earnings. And the second way is the multiple expanding, right? So the stock price is a function of earnings and the multiple. So what we do, where we differentiate ourselves, is more on the earnings side. So we try to find investment ideas where the earnings potential that we see far exceeds analyst expectations. So once those analyst expectations start matching our expectations, that's when we take profits on our investment. And we basically are usually invested in around 20 companies at any given time, but then we have a strong bench of another 10 companies. So once a company is reaching their price target and return and has generated returns, that's when we sell. The other time we sell is when we're wrong, right? So we have a very clear thesis of what we're playing. And if that thesis changes for any reason, we would be taking profit or exiting the position. So that's a little bit about our fundamental process.
As you put it all together in these times, you talked about regulation being important, and we certainly are seeing a lot of regulation and government stuff. But as you pointed out, impacts of things like tariffs have been maybe more muted than expected. How quickly do you go from, the public thinks, oh, here's a story, and then the media comes in and says, this is what the reaction is going to be. How much confirmation do you need? Like if you're looking at something and you go, this is a trouble spot, how much is it? Oh, we just saw a regulatory thing. We think it's a headache. We're out. How much is it? We're going to sit here and wait to see how it plays out.
Well, we have a longer term horizon, so we can wait if we think there is a potential opportunity coming. Our thesis is usually quite well laid out to a point where if it changes, we do change our view. So I'll give you a few examples of situations where the fundamentals change, right? So, for example, Tesla is one where we see a lot of potential upside going forward. But we also believe, as a few months ago, that there is going to be a very favorable regulatory environment for them. Now, with the recent exit of Elon from the White House and how that whole thing played out, the risk increased pretty significantly on the regulatory front. So we took profit on our investment and reallocated to other ideas that have similar upside potential, but don't have the risk associated with it.
Interesting. And now that we know how it all plays out, we're going to put you to the test of our audience.
Quick and dirty.
This is going to be cool.
Yeah, it is cool when we get the take of an expert on a stock that you guys are particularly interested in. And that's what we're doing now because Quick and Dirty, our lightning round, is up with Ivana Delevska, the founder of Spear Invest, which runs the Spear Alpha ETF, ticker SPRX. Learn more at Spear, like you'd expect it to be spelled, spear-invest.com. We start today with a request from David in Missoula, Montana. He wants to know about Cloudflare, its ticker symbol NET.
So Chuck, we love Cloudflare is one of the top 5 holdings in our ETF. The reason why we like it is because they're providing the platform on which companies can build their AI products and tools. In addition, they have a pretty strong cybersecurity business. So as we see AI adoption broaden out, the potential upside for Cloudflare is pretty significant.
Sounds like the opportunity of a lifetime.
That's a buy on ticker symbol NET, Cloudflare. Our next request comes from Troy in Mount Laurel, New Jersey, and Bill in New Orleans, both of whom want to know about Asana Incorporated. The Class A trades under ASAN.
So Chuck, to your point of AI becoming a threat for some companies, the software layer has become really the main area where this applies. So now a lot of people are worried that AI will not only take the jobs of people, but will also displace some of the software that is used, whether it's for productivity, sales. So really, software we've seen come under a lot of pressure, and we think is one of the areas to avoid until we have more clarity on what is it exactly that they're how is it exactly that they're positioned to capture the upside of AI.
Well, maybe it's time to sell this.
Yeah, so you put it all together. That is a sell on Asana, ASAN. Pat in Swansea, New Hampshire wants to know about Intel, INTC.
So Intel looks very interesting here, especially with what the company is doing on the transformation side. We don't own it at the moment because it's still very early in their transformation. There is still a lot of uncertainty, but this could be potentially an interesting transformation story. The new CEO is very capable, Lee Bhutan. He is trying to make deals and turn this company around. It's not going to be a no-brainer to turn it around just because of their founder business is losing a lot of money, so they need to fix that first. But they're definitely leading in the right direction. So I would say neutral to look out for a buying opportunity.
Yeah, so you are looking whether or not you're going to take your shot on this one. Hold, fire! With no guarantee that you're actually going to pull the trigger, but that is a hold, wait a little bit longer on INTC Intel. Amy in San Diego wants to know about Nibius. It's ticker NBIS.
So Chuck, we don't own Nibius mainly because we see this area as being a little bit too risky for our investment style. Just to give you a little bit of a broader framework is some companies on the AI space depend on CapEx And while there are large numbers being spent, we don't know what the returns will look like. And then some companies provide the picks and shovels. We see better risk reward in the picks and shovels versus the companies that are putting out the big CapEx numbers. So it's not a terrible buy, but it's a very risky buy.
Yes. So speculative enough that you have not taken a chance on it.
Well, I've always been a risk taker.
But if somebody out there wants to go super speculative, Nibius, NBIS, well, there's your call. And last, for Richard in Chula Vista, California, it's Amphenol Corp, ticker APH.
So Chuck, Amphenol is really well positioned on the picks and shovel space. We've owned it in the past. We replaced it with a company that we think has a little bit more upside, which is Astera Labs. But we do really like Amphenol here as well, especially if you're looking for a lower risk investment.
Well, having just come through with a high risk investment that you couldn't buy, at least not yet, we finish on a high note with a buy on a lower risk investment, in this case, APH, Amphenol.
Buy. Is that all you can think about?
Well, no, we've had other things besides buys in there, but now we've got one more good buy that we have to think about. It's the one where we say our goodbye to Ivana Delevska. But Ivana, great to catch up with you. Thanks so much for coming back to the show. We'll talk to you again down the line.
Always good chatting, Chuck.
Ivana Delevska is the founder of Spear Invest. They run the Spear Alpha ETF, SPRX. So think of it as SpearX and not Sparks, but SPRX, the ticker. Learn more at spear-invest.com. We'll come back. We'll let you know where Ivana agreed or disagreed with some recent guests, and we'll cross the finish line together in a moment.
Hi, everybody. Rob Floyd, Money Life's executive producer. And I'm back with another contest where you can win a book that was discussed on the show. On Tuesday, Chuck interviewed Victoria Bateman about Economica, a global history of women, wealth, and power. The book is all about how women made the world rich. And rich women is what this week's contest is about. Specifically, you have to tell us who Forbes magazine currently counts as the richest woman in the world. Send your answer to chuck@moneylifeshow.com by noon Eastern Time on Saturday, October 4th, to be entered into a drawing to win the books. And please put the word contest in your subject line. Good luck.
We are back to wrap things up. Thank you so much for sticking with us. And a little bit of an unusual show in that the other interview and the big interview very much covered the same ground today, which they typically don't. Typically, an other interview will be like a specialized thing where somebody's talking about sectors or something along those lines, but doesn't always work that way. This week, not working that way. But let me know what you think. If you wish more of this, less of this, if you wish you'd go back to more shows with 4 interviews, whatever it might be, I really do respect your opinion on this. You guys are the important ones here, so don't be shy. Chuck@moneylifeshow.com. And remember, we've got a contest going this week. You can always send in picks for quick and dirty. Like, it's okay to have a note do multiple purposes. And again, we appreciate the notes that have been telling us whether you've been finding the show or not as expected, particularly at Apple Podcasts, because we've been dealing with some issues there, and we're trying to make sure that our voice is being heard on, hey, fix this and know that this problem's not gone away. Or at least not gone away every day. Hopefully it won't happen again today. Ivana Delevska, a little bit of crossover there. It started with NVIDIA because she talked about Constellation Energy, and then she talked about NVIDIA as being exemplars of what she was looking at. Chuck Carlson from Horizon Investment Services and the Best Dividend and Income Investments newsletter was buying it back on September the 10th. Seth Cogswell of Running Oak was trimming. It wasn't a sell, but a rebalance warning a day before that, September 9th. Tom Martin from Globalt Investments was adding to it on August the 18th. Patrick Healy from Caliber Financial Partners was buying it on July the 28th. Dryden Pence from Pence Wealth Management was buying it on July the 2nd. Burns McKinney of NFJ Investment Management was a hold to a sell back on April the 23rd. And that was a day after Francisco Beto of FM Acceleration was buying it. So we go back 6 months. That's as far back. Mostly buys, but not quite buys. A few warnings about how much of your portfolio is becoming. During Quick and Dirty, Amphenol. That was Chuck Carlson's poster child. Oh, there was one more. Arista Networks, ANET, ANET. That came up before Quick and Dirty. David Miller from the Catalyst Funds was buying that back on August the 1st. So you had some agreement there, but for different reasons because David Miller, a very different kind of investor. Tomorrow on this show, Todd Rosenbluth with the ETF for the week. Ed Campbell, principal at Red Hook Phoenix Investment Partners, will be talking about the intersection between AI and nuclear power, among other things. But that's an interview that you guys were talking about. You wanted more of that. Help us mix the AI and figure out where it fits in with energy. That's part of what we're going to be talking about tomorrow. And also Adam Coons from Winthrop Management will be here talking ETFs in the market call. Meanwhile, if you are looking for something to celebrate, there's a lot of choices today. It is National Walk to School Day, National Coffee with a Cop Day. I will not be having coffee with a cop because I don't drink coffee. It is National Fire Pup Day.
Did that dog just say hi there?
Well, if the fire pup didn't, the black dog might, because it's also National Black Dog Day. And here, where we live close to Martha's Vineyard, and there's the Black Dog Cafe, that is not about that. It's just about celebrating black dogs. It's also National Hair Day, which you should always celebrate your hair if you still have it. And then on the food front, a lot of different things. It is National Kale Day, National Pumpkin Spice Day. Those are two things I do not like, kale or pumpkin spice. Sorry, I know a lot of people do like it, but I'm not going to be celebrating those. It is National Pumpkin Seed Day. Pumpkin seeds, sometimes called pepitas, you can use them as a sub for pine nuts, for example, in pesto, and they're worth it. It is National Jiffy Mix Day. It's the first one of those, and the people who put out Jiffy Mix, Chelsea Mill & Company, they founded this holiday. That kind of feels cheap to me. Like, maybe I don't want to celebrate just because you're like, hey, it's my holiday. Whatever. And then it's National Homemade Cookies Day.
C is for cookie. That's good enough for me.
Yeah, homemade cookies, any kind of cookies are good enough for me. So always a good excuse for that. My guests today were David Bush, Co-Chief Investment Officer at Trajan Wealth, Trajan, TrajanWealth.com. Jeff Blazek, Co-Chief Investment Officer for Multi-Asset Strategies at Neuberger, Berman, NB.com. And Ivana Delevska, founder of Spear Invest, spear-invest.com. Thanks to them. Thanks to Rob Floyd, my producer. Thanks to Maho, my dog. But mostly, thanks to you for being here, because you make this special and worthwhile for me each and every day. The Money Life quote of the day comes from Charles Ellis, who has been a guest on the show but didn't say this on the show. And he said, when you think the market's too high, don't do anything. And when you think a particular stock is a hell of a buy, don't do anything. Yeah, well, we want you to come up with the right course of action. And most importantly, that means keeping your emotions in check. So remember, until we do this again the next time, the best thing you could do for your money is not worry too much about it. Have a great day, everybody. Stay safe and calm. We'll see you here on Money Life again tomorrow.
The people who appear on Money Life are here for your and their own entertainment. Don't take advice from us or any other podcast without doing more research and/or consulting your financial advisor. We believe our guests provide reliable information, but we can't and don't guarantee the accuracy or completeness of their statements. Opinions expressed on Money Life are those of the host and guests only and reflect their personal thinking. They're not representative policy or strategy of any employers or sponsors. This show is produced by Money Life Radio, which retains all rights to the content. If you want to use any part of this show for your own purposes, be they good or evil, you must get our written permission first. And remember, with great financial information comes great responsibility. Please act responsibly.
Another day, another nickel.